Good morning, everybody. I'm Chad Koulis, Executive Director of the Midway Chamber of Commerce. Thanks for joining us. This is a speaker that's back by popular demand. A lot of you were here to see him back last August in 2019. We had a luncheon at McAllister, and he's back, and a lot's changed with our economy since then, so it's going to be a very interesting talk and probably much different than the last time we saw him. At this point, I'd like to welcome our board chair, Jameson Randall. Jameson.
All right, good morning, everybody. Thanks for attending. It's great to see everybody's face out there. We're at the Midway Chamber. We're excited to be celebrating over 100 years of building a stronger Midway. And it's thanks to a lot of you. And we have so many talented, wonderful people that are part of this organization, our membership. So it is great to see these events happening in a virtual setting, and can't wait to see you guys in person, all you guys and gals in person again. First of all, I want to recognize we have some ambassadors here today. If you're an ambassador, if you could wave out to us or click your reaction wave button. Looks like we got Pam. Pam's out there, and Joe. Who else we got? There's a few more out here. Also would like to welcome Sabrina, or we actually have a new member. Sorry about that. We have a new member. We're excited to introduce is Laura Tomaszewski from Handy Medical Supply. Let's give her a big round of applause. We love having new members. Now is a great time to be part of a chamber because we all need our support to support each other and help grow everybody's business. So up next, I'd like to introduce our Vice Chair, Sabrina Fay with Thrivent Financial. And she's gonna talk about some opportunities coming up here with the Midway Chamber. Sabrina, take it away.
All right, thank you, Jameson. So this morning, I'm happy to be representing our Board of Directors from the Midway Chamber as your sponsor for today. So we were happy to bring in Ron as our speaker. As Jameson and Chad both mentioned, he was one of our popular speakers last year. So you may be asking, what would happen if you sponsored an event like this? So if you were at the mayor's talk last week, you would have noticed we had 83 people on the Zoom event, and all of our events are recorded, and that allows people to watch them afterwards, so that when you are a sponsor, you have anywhere from 2 to 5 minutes at the front of the meeting, just like I am right now, able to share an event or news about your business. And then you also have the opportunity, of course, that's recorded, so you get all of the impressions during that time. You can also moderate and introduce the speaker. And then you also will have the link for your website sent to all attendees. You get your logo on the event page, and it's also in the newsletter. The investment for doing this is only $500. Upcoming events that we are still looking for sponsors include an economic development meeting on the supply chain that is coming up on October 27th. We also are expanding the format of our celebration of nonprofits, and that is starting on November 5th. What's exciting about that, as you're probably aware, is our Minnesota Give Him In is in November. So that's going to allow us to kind of capture the energy around that. Then we have David Schultz on November 10th. And then we are also working on a series of programs dedicated to equity inclusiveness. So those are also some other events that we are looking for sponsors. And then finally, we are looking for both sponsors and members that want to be part of the planning committee for our annual celebration. All right, so those are all of the activities and opportunities. And if you are interested, please reach out to either myself or Jameson or Chad, and we would love to connect you. Thank you so much.
Thanks, Sabrina. And now we're going to get into our program with our keynote speaker. I'm going to do a quick intro. And I'll also just remind everybody, if you have questions, put them in chat. You are on mute right now, but unmute yourself if you need to speak, like Ron will be in a second. Ron Wirtz is a Regional Outreach Director for the Federal Reserve Bank of Minneapolis. Ron's primary responsibilities involve tracking current business conditions across the 6-state 9th Federal Reserve District, which includes Michigan's Upper Peninsula, Northwest Wisconsin, Minnesota, the Dakotas, and Montana. Ron tracks activity in employment and wages, which are central to the Federal Reserve's dual mandate of promoting stable prices and maximum employment, along with construction, real estate, tourism, and consumer spending. Please welcome Ron Wirtz.
Thank you very much, Chad. Thanks, Jameson, Sabrina. I really appreciate the opportunity to be here this morning. Thanks, everyone out there that's watching for taking the time in your busy day to start here. Let me get my screen up to share, and I will get started. So I have a lot to offer today, but first I just want to, again, thank everybody for taking the time. I really find the opportunity to get in front of businesses and business communities really useful, in part because I'm going to share some information with you, but whenever I'm in front of a group of businesses, there's an opportunity for me to also get information from you. So there's going to be some things here that are interactive that I think everyone's is, along with the things that I'm going to share, you're going to help us all learn as well. Before I get going, let me reduce that, get that out of the way. I have to give you my disclaimer. Views here are expressed are mine, not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So today I'm going to talk about the data challenge and the need for better real-time information due to the pandemic. I'm going to talk about who's been affected by the pandemic and to what extent. For the most part, I'm going to talk about, or to start anyways, I'm going to talk about 2 July surveys that we've done, one on general business and one on construction. Now, I want to acknowledge that we just recently did a survey that the Midway Chamber was partnered with. Those results literally just came in this week, or the survey closed. So I'm going to be presenting information from our July surveys. I don't expect that a lot of the things that I'm going to tell you have changed dramatically. And the utility is that I'm also going to be doing a webinar next week, kind of releasing some of these new results as well. Then I'm going to talk a little bit about workforce effects. And then at the end, I'm going to talk about consumer sentiment and the virus and what the outlook is. As I mentioned, during this presentation, I'm also going to be doing an interactive survey to essentially get your feedback on how you see the economy right now. So in advance, I want you to get your phone, because this is a survey, a cell phone based survey that we'll have to log into that I'll do shortly. I'm going to present an awful lot of information to you. I'm going to keep things moving though, especially in this webinar format. I find that making sure things kind of keep an even pace is really important. So don't focus too much on any single chart, because I'm going to keep things moving. Focus on the macro themes that I'm talking about, and not the chart detail. I will be sharing this PowerPoint with Chad, so anyone that's interested in receiving this will be able to take a deeper look later. So I need to get everyone logged in for the interactive survey. One of the things that's really important is I need everybody to participate in this. The more people on this call that participate, the better the information we're going to get. When I pop up a question, we're going to see real-time immediate results. So we'll actually get to see those. You'll be able to take this information away with you as well. So to get logged on, I need you to have your phone. And if you go to step 2, and Chad, if you wanted to put step 2 and step 3 in the chat box, that way later on, if anyone logs on, that information might be available for other people to log on, or if they're having difficulty. But you're going to send a text to the person that is 22333. Okay, and in the text box, you're going to type the word Minneapolis. And if it capitalizes, that's just fine. And then you're going to hit send. So you're going to send the word Minneapolis to the person that is 22333. And after you hit send, you should get a little pop-up box in your text that says you've been logged on to a survey. Chad, I need you to, because I can't see you, I need somebody to give me a verbal cue that people are getting logged in. Once you've logged in, if you could give Chad a signal of some sort to let him know that the technology is working, that would be great. Stay in text mode. Some people are inclined to hit the hypertext link that's in that little pop-up box. Don't do that, just stay in text mode. The only thing we'll do, it's all multiple choice. You'll just be typing a letter and hitting send once we get to the questions themselves. Chad, are we having luck getting logged in?
Yes, I've seen 3 people so far in the chat say they're logged in, and I'm in.
Okay, all right, great. So I'll wait just a little bit longer. While we're doing the, when we do any of the survey questions, there'll be a little bit of time as people are reading the question and filling in their answers, that if there are any questions, I'd be happy to take questions during that period. So at any point questions come up, let Chad know either in the chat box or other ways to let him know that there's a question you'd like to ask. All right, we're gonna move forward just to make sure that the technology is working. Oops. There we go. Okay, so the first question, this is just to let me know that that the technology is working. Bank also likes to know what people think of it going in. So all you have to do is hit a letter. So we're curious how you would rate the Minneapolis Fed as a thought leader on the regional economy. So if you could do one of those, that would be great. And see, again, just to demonstrate the technology, you get to see results as they roll in. I won't be spending too long here. So it looks like, for the most part, people have a decent opinion of us. Always good to know going in. Okay, so let's get started on the rest of it. So the COVID data challenge. So the speed of the pandemic has really increased our need for real-time information. As you might guess, the Minneapolis Fed has always gathered an awful lot of information, but a lot of the macro data that we've typically depended on is time-lagged, either by weeks, sometimes even months if you go to gross domestic product data. So it's a lot less COVID relevant in this environment. So what we have started to do to fill that information gap is we're doing a lot more outreach and we're seeking new kinds of data. So some of the stuff that I'm going to talk to you about have to do with the surveys that we're doing. We've done 12 surveys since mid-March, and we've reached 10,000 businesses over that period to let us know how the pandemic is affecting their business. We've also gotten an inordinate number of open comments that really have given us almost a story about how businesses have been affected really at a granular level. So we did a July survey of general businesses that I'm going to speak about. There are 1,100 responses to that, as well as a construction survey done shortly thereafter with over 600 responses. Then I'm also going to intersperse some additional real-time data, some things that I'll talk about in terms of the new things that we're trying to gather at the Minneapolis Fed to give us a more real-time idea of what's happening. So the general business survey that I mentioned, again, we did this over the entire 9th district that Chad described, from roughly western Wisconsin to Montana, 1,100 responses. So I want to orient you a little bit to a series of charts that are going to be coming first. So basically, we asked businesses about estimating COVID's effect on average sales and revenue at 2 different times. So we asked them to compare June and July to the previous 2 months, April and May. We asked them to compare June and July to the coming 2 months, August, September. In terms of the color scheme, what you need to know is red means bad and darker red means worse, okay? And basically what I want you to take away with this chart is that roughly half of our respondents saw a negative revenue trend in both periods. So over that period compared to earlier, as well as going forward. So we're seeing that many, many businesses have been affected negatively by the pandemic. That's not exactly surprising to anyone. Everyone's familiar with that. What I'd like to do now is tell you a little bit more about how that breaks out. So we asked businesses to identify themselves in a number of ways, including geography, firm size, and industry sector. And what we found out when we took a little bit closer look by geography or by state, is that geography does tend to matter, but it only matters some. So we know that different states have taken a different policy approach in terms of restrictions on businesses. We know that South Dakota in general has taken a lighter approach in terms of business restrictions. And we do see that they're having what I would say is a smaller effect. But what I would say in general is that you're seeing everybody is having effect. So these results are more similar than they are different. But there are some differences. So I think state policy probably plays some role, but it's more likely on the margins. And I say that also because composition makes a difference. And in terms of the respondents we had from South Dakota, one of the things that they didn't have, I saw literally no sole proprietors as part of their sample. And that matters because size matters. Okay, so this is probably the most consistent finding that we've seen through all of the surveys that we've done since the start of the pandemic, is that size matters. Again, not that large firms are not unaffected. If you were to only look at this very top chart, this very top bar of firms that have more than 250 FTE employees, you would see this as a catastrophic outcome if you saw no other bar than that. Just so happens, though, that unfortunately, the smaller the firm, the worse the outcome in terms of effect on revenues. We also asked firms to identify the sector that their business was in. And again, you see very widespread impact. But what you see is that there are some outliers in this. We've generally heard that those in entertainment, recreation, accommodation, food and drink, those are the ones that have really been hurt the most. Again, maybe not surprising if you step back and think about the places that have seen, that are crowd facing, those things that have maybe more interaction, depend on crowds, things like that, have been more affected than those that have an ability maybe to work from home or have ability to put things in place to make operations kind of go back to somewhere close to normal again. So now I want to shift quickly over to our construction survey. We consider the construction sector to really be kind of a bellwether for the economy. If you think about your willingness to maybe go and build a new house or to invest in a new office property or any property, it's really a bet on the future and your ability to pay for that building going forward. So we really see it as an indicator of confidence going forward. And what we found in the survey of more than 600 construction firms is that we're seeing an awful lot of delays in projects. Excuse me. We're seeing an awful lot of delays, go back. We're seeing an awful lot of delays both in public projects and private projects. Probably more important though is we're seeing cancellations in both public and private projects. Not necessarily a significant amount in any case, but even at 10% that are seeing significant cancellations, that's important, but almost 50%, 40 to 50% are seeing at least some cancellations in their pipeline. Now, what we saw going into 2019 was a very, very confident construction sector, very full pipeline. So we've seen the construction sector has actually been able to stay still fairly busy because they're building up. I think they're pulling a lot of building projects forward as things get delayed or canceled. What we're more worried about though is the fact that we asked them about their request for proposals. Essentially, what are you bidding on for future work and how is that changed? And what we heard from our respondents is that they are seeing, again, red means bad and dark red means worse, is that they're seeing a somewhat or significantly lower level of requests for proposals out there right now. So that's worrying to us because that's signaling that buyers out there are getting a little bit more nervous about whether or not they should be investing in new construction. Not surprisingly, for the work that is out there, construction firms are seeing a lot more bidders go outside their normal markets. So I just told you a little bit about our July surveys. I only just want to make mention that we recently conducted a survey in early October. Midway Chamber was a first-time survey partner in that. I want to thank the Midway Chamber for being involved in that. It's through these partnerships that we are able to get such wide and deep insights into the business community right now. So I want to thank them for participating. If anyone on the call happened to be a participant in that survey, I want to thank you. I have not had a time to really analyze those results. I will be over the next several days, and I'll be doing a webinar on that on October 21st. More information will come hopefully from the chamber for you to register for that, but I just wanted to let you know. So for the most part so far, I've been able to tell you about what we knew roughly in late July. So I'd like to use this audience right now to tell me how things have gone since then. Okay, so I'm very interested in knowing how your recent business has gone roughly over the last 2.5 months. So since August, how have you seen your own revenue and business? So, and if there are any questions, Chad, if at any point you want to throw those out, I'm happy to tackle. And early results are really quite positive. I would say more positive than I'm generally used to seeing, which is fantastic. I'm thrilled to hear that that businesses are managing. So it looks like about a quarter across the board, roughly, but generally positive. I'm thrilled to see that. So that's what we've seen over the last couple of months. I'm curious now, again, as a confidence matter, I'm interested to know about future business. So taking the last couple of months and projecting it forward, how would you compare what you see by the end of the year for the remainder of the year compared to the previous couple of months? So given that the last couple of months have been relatively positive, keeping that unchanged, probably not all bad, and some are seeing actually higher, although not everybody. A little bit, maybe a little bit higher share here that are, looks like roughly a third, expecting to see things maybe a bit lower. So I would say not a really strong outlook, but also given circumstances and the uncertainty, I would say this reflects more of what I generally tend to see when I talk to when I'm in front of business audiences. So let's talk about workforce. So we've talked a little bit about firms and the effect there. If we were to talk about workforce, I think folks are generally familiar with the general trend in unemployment. You have earlier in the year, pre-pandemic, that was quite low, very low, and then you had this shock to the unemployment system where it went above Great Recession levels, and it's been followed really by a very steady recovery in the unemployment rate in general. You have Minnesota, I believe, at a little under 8% right now, and figures for September should be released at the end of this week, actually. What I would tell you is that in terms of where the unemployment is headed right now, is only that there are some labor market anomalies that are out there that I'm kind of curious to watch to see where things go right now. One of the things I tend to watch a lot are unemployment insurance claims, and there are two lines here that I want you to just describe here quickly. You have weekly initial claims that are the blue line, and you saw them go to a level that I really didn't think was possible at the time. They've come down very steeply, and they've really leveled out of late. Now, what I would tell you about where things are right now, this is roughly through the end of September. We're seeing a very steady rate at the end of September. That seems low, but it's still roughly about 3 times what we would normally see at this time. So there's still a lot of initial claims kind of pouring into the system. What I would say is that initial claims probably not a great measure of unemployment. And I think continuing claims do a better job of that, because continuing claims are those that are actually in the system and receiving benefits. And you see a roughly similar trend overall, a slower decline. And right now, we're at, I think, roughly 175,000 continuing claims. The one thing I want to point out is that's still significantly above the peak in the Great Recession. Okay, so there's 137,000 continuing claims. Was the peak in the Great Recession. We're still we're still at 175,000. We're still roughly a quarter above that. And I think there's a lot to still shake out in terms of what we really know about the unemployed, in part because, as I understand from deed folks, that continuing claims also don't count some of the expanded eligibility that came from the CARES Act. So I also want to talk about workforce effects in terms of who's been affected. And what we've seen is that there are a lot of racial disparities in terms of who's looking for unemployment insurance benefits because they've been laid off. So in terms of continuing claims, that same chart that I showed you before, now this only goes through August, so it's not quite as up to date. But basically what we see is that there's been a very big increase among white claimants. Not surprising, the large majority of the labor force in Minnesota is white. Okay, but what we're seeing is disproportionate numbers of Black or African American, American Indian, Hispanic, and Asian claimants as well. If you look at it, if you look at continuing claims by race as a share of all continuing claims, what you're seeing is that from February to May to August, you're seeing the share of white workers, their share is going down very consistently, while the share of the remainder is increasingly Black or African American. Okay, so we're seeing real disparities in who's being affected from a workforce standpoint. Initial unemployment claims that move to that other, for those that are initially applying for, what we're seeing is that there are a lot of disparities and a disproportionate number by education and by gender and race and ethnicity. So I don't have gender here, but roughly there's a disparity. There's been more women that have been displaced than men. The share is a little bit more even than the ones that I'm showing you here. But by high school, as a share of all of the labor force that has a high schooler diploma or less, 50% of people through July had applied for unemployment insurance. Okay, and that level goes down by education. In terms of race and ethnicity, what you see is that roughly 50% of black workers as a share of the Black labor pool have also applied for unemployment insurance. And the Native American population similarly very disproportionately affected. I see this as not only a social emergency, but it's also an economic one. I think anytime you see imbalances, I think what we're seeing is that there are inefficiencies in the economy. These are outcomes that I think are really important for the economy to get right. And so I think for reasons related to the George Floyd killing and some of the social unrest related to that, I think we have to start really being honest about where the distortions are when emergencies and when recessions hit like this, that we have to be able to do better than this. So in terms of recovery though, and the job market, some of the good news is that we are seeing more job postings come into the market, and that's a very good thing. What I would say is that we have seen a nice rebound once the Minnesota economy rebounded. But what I would say is roughly since late July, if you look at late July to the end of this, is that it hasn't moved an awful lot over this period. It actually declined a little bit in August, starting to climb back, but for the most part, we're still 15% below where we were a year ago. I also want to just point out, this is one of the many charts that we have posted on a new website that we're hosting, COVID-19 and the 9th District Economy. There's a dashboard that we've put on that has a lot more real-time information in terms of job postings, consumer activity, other things that we're trying to do a better job of getting measures of the real-time economy. We're trying to share that with the public so you have information as well. So if you go to our website, if you're interested in a lot more data like this, COVID-19 and the 9th District Economy dashboard, you'll find it online. So there are also certain sectors that are seeing a quicker return of jobs than others. And we're actually even hearing of some labor tightness in certain sectors. Overall though, what I would tell you in terms of in terms of workforce cuts and where they're coming is that it's not unlike if I were to show you, match this over the revenue chart that I showed you earlier, those that are seeing a bigger revenue impact are seeing more job cuts. You know, particularly leisure and hospitality. As I showed you in the earlier chart, they're really getting hammered from a revenue standpoint. We're seeing much larger job losses as well. So I've told you a little bit about workforce. I'm curious what's happening at your firms. And I'm wondering if you could tell me what best describes staffing at your firm over the last 2 months. So it looks, again, quite a positive outlook right now among folks that are online. That is also great to hear. I would say, again, I generally have, I would say, fairly close. What the survey data has been showing us is that those trying to hire and those cutting are roughly equal in our larger sample surveys. So we're seeing what I would say is a fairly volatile employment market. There are certain sectors I think that are recovering more quickly, and there are some that are continuing to struggle and seeing with the PPP loans now kind of exhausted. We're seeing that in certain sectors like hotel and accommodation, we're starting to see a little bit more permanent reductions. What about in the future? What do you expect to happen to staffing levels over the remainder of the year from now? And Chad, I'm wondering, have you gotten any questions in yet?
No questions yet. I just
Okay.
wrote a comment. I'm curious, the previous question, how many people who said they're adding jobs are really adding jobs that had been laid off before or reduced earlier in the year?
That is an excellent question, Chad. And yes, if folks are interested in kind of offering some commentary on anything that I've had to say, whether it's in support or maybe in contrast to some of the things I've said, or if you just want to add some color, I would really love to see any of those comments afterwards, Chad, as well, just so I can get a little bit clearer idea on where people are coming from. But that's an excellent question. And actually, now that I think about it, I might have to start tweaking. I might tweak my question, my last question, a little bit to make sure that that's accounted for. But it does look like, again, for the most part, expecting to hire, not dissimilar to what I showed you in terms of job postings. I think there is some return to the job market. In terms of wages, what we have seen historically, wages tend to be sticky. What more tends to happen is that there are labor cuts and fewer wage cuts. What we're seeing is that it's been both. There are firms that are laying off. We're also seeing more wage cuts than we have typically seen like that in the Great Recession. And what we tend to see is that the smaller the firms, the more likely they are to actually cut wages. And what we've seen also is that the cuts have not been small. Many of the cuts have been 10% or more. So what about you? How have recent wages been acting at your firm? So first, I'd love to know what's happened to wages since the onset, so the pre-pandemic to now.
Ron, while people are answering this,
Yeah,
there's been another question here on the
yeah.
chat. This is from John Young. He says, Ron, thank you for being here. Every time we have increased federal spending to help us out of a recession, there are concerns about huge increases in future interest rates.
Yeah.
That did not occur after the Great Recession. Do you think we are in danger of that after this recession?
What I would say is yes and no. Yes, because anytime we are overspending, anytime we are increasing debt, there are going to be problems. There could be potential problems with that. We have more money chasing fewer goods. That's a definition of inflation. The problem or the curiosity, the challenge right now is that much like out of the Great Recession, everybody was expecting inflation to come roaring back. It never happened. We have actually struggled to maintain that 2% target that the Fed sets as an inflation target in terms of setting interest rates. So without a doubt, inflation could be problematic on the other side of this. My boss Neil Kashkari is more eloquent than I am on this, but basically the argument is if we were not to do more federal spending, we would be seeing a significantly deeper recession. So the problem is it kicking the can down the road a little bit? I think it is. I think that's fair. At the same time, we have to try to revive the economy in order to have the growth necessary to pay for the debt that we're taking on right now. So the alternative essentially is worse if we were not to take on some of that federal spending, like the PPP loans that we've heard, generally speaking, have been really quite successful in keeping some firms through a very, very rough patch. So I would call it the lesser of two evils, maybe even by a fairly significant margin. So I don't think there's any question we will have to worry about what happens when things go back to normal. But for right now, we think it's the better path. And so much like we have been hearing, for the most part, we have seen more firms decrease wages than we have typically seen in recessions. So what about in the future? Do you expect by the end of the year, what do you expect to do, say at year end when lots of wages get adjusted either up or down? And here it looks like maybe some wages are going to bounce back by the end of the year. Maybe some reinstatement of previous wage cuts. It's hard to know exactly. But again, I think what these results show and that I see in most of my surveys is that this is a really volatile time. I wouldn't ever see anything, any wage cut at all previous, to the pandemic. So there are lots of firms having to do lots of different things in order to stay viable, and that's completely understandable. So now I want to spend the last 10 or so minutes chatting about the economic outlook and the virus and consumer sentiment. And I'm going to do it kind of in reverse order. So for the most part, when I come to talk to groups, I feel like I'm really, unfortunately, offering kind of a not great news scenario. In June and July, I think we did see some real relative strength and bounce, in part because of that huge federal stimulus that we saw, as well as the reopening of some state economies, including Minnesota. Since then, I would say overall activity has been more mixed and it's really fairly volatile. Some sectors are appearing to recover a lot more quickly than others. There's still a lot of uncertainty. Going back to some of the construction charts that I showed you, I think there really is uncertainty going forward about what lies ahead. So in terms of the outlook, we're starting to look more and more at consumer confidence for some clues. I'm really curious first to get your patterns of behavior right now as it relates to the pandemic as a consumer. So I'm wondering if you could tell me kind of how out and about you are compared to pre-pandemic levels. How would you describe your activity or your mobility as a consumer? So what we're seeing is something that I am seeing very regularly, and there is a small number, typically about 1 in 10, that are mostly still living in their lives like they were previously in terms of mobility and being out and about. Okay, I'm going to move forward. Maybe I'll give another response or two come in there. Okay, I'm going to move forward. So activity doesn't equal spending. Okay. So I would like you to tell me, because we all know there's lots of new ways, or there's just maybe more enhanced ways to spend money now. I'm wondering if you can tell me what your consumer spending levels are now compared to pre-pandemic. So right now we're kind of coming in at about 50 to 60% on a kind of on a changing. Let's say more than half are moderately below pre-pandemic levels. So the 30 or so consumers that are online here, roughly 50 to 60% of you are moderately below pre-pandemic levels or more. Okay. So what we saw in our survey results was roughly the same thing. So what we heard, so the chart on the left asks them about their operating or production capacity compared to pre-COVID levels. And for the most part, again, red means bad and dark red means worse. Roughly 50% of respondents were operating at 75% of capacity or less. So we do have reduced capacity out there. And I think there's a lot of complaints about government policy and the openness of our economy. But what I would tell you is that they also told us that customer demand for their services and products was also well below their existing capacity. So you basically had 3/4 of respondents, roughly 70%, were, despite reduced capacity, were still seeing customer demand that was not hitting the top of their existing capacity. So again, there is this lagging customer demand that I think we're trying to pay more attention to in terms of what it means going forward. One of my last questions that I'll ask. So I'm curious, if we opened up the economy, I hear this a lot, especially in the survey, I get a lot of comments on this. We just need to open up the economy. So I'm curious, if we eliminated all COVID-related restrictions on businesses, large crowds, masking, social distances, I'm wondering how your mobility and spending would change. So for the most part, it looks like most would not change, or there would be maybe slight increases. Some would even decrease. for the most part, I think it's safe to say from these survey results that we would still be seeing a consumer demand that was less than what we hypothetically, especially if we opened up and all the businesses could be at 100% capacity, we would still see consumer demand that was significantly below what they could meet in terms of demand. It's demand that is actually lagging right now. But there would be some increase, okay? So we might see some bounce if we just completely open up the economy. What I'll tell you in terms of outlook is that what we're seeing is there seems to be some relation between consumers, the virus, and what we see for an outlook. So my bank president, Neil Kashkari, has been fairly outspoken on this matter in that he believes the recovery is likely to be consumer driven and that it will be connected to infection and mortality trends. And that real lasting economic recovery and growth are going to start with controlling the virus, at least until there's an effective vaccine or treatment. It doesn't mean that we can't stay on a current path, irregardless of what the virus does. But he believes that failing to control the virus is basically going to mean a much longer, slower path to recovery. The survey, the questions that I just offered seem to suggest, even within this group, that as a consumer group, you're spending less than you did pre-pandemic, and you're likely to continue that. Mostly, maybe there'll be a small increase, but you're still not going to come close to pre-pandemic spending levels, even if we were to just take all of the restrictions off. So what's happening right now in terms of COVID trends? I think the group is probably fairly familiar with what's going on in Minnesota. What you might not know is what we're seeing in other states, so I offer a few comparisons. Again, this is on our COVID dashboard for those that are interested, but we're looking at new cases per 1,000, okay? Minnesota's the dark line, so Minnesota's been doing better than its neighbors. We're seeing significant increases in Wisconsin, both Dakotas and Montana, so they're seeing significantly higher caseloads. We're not only just testing more, though, we're seeing higher ratios in what's called the positivity ratios. In other words, for the number of tests that are taken, how many are testing positive? So if you're testing more and you're seeing a higher positivity ratio, that means there's really an increase in the overall infection rates going on there. Again, Minnesota doing significantly better than its neighbors. There's generally I would say at least an informal benchmark of a 5% positivity ratio or lower for 14 consecutive days. Almost none of the states are meeting this standard right now. Minnesota's coming fairly close, but even here it's kind of zigzagging up and down. Way better than 2 other neighboring states though. In terms of the virus and economic activity, some of the more real-time measures we're getting are suggesting that consumers are reacting to information like this. So in South Dakota, if you go back to earlier in the presentation where I showed you that some of the effects were a little less pronounced there. So what we're seeing in terms of retail and recreation foot traffic, again, this is on our COVID dashboard. In South Dakota, here you have this big jump. This is the Sturgis motorcycle rally. So we know there's some sensitivity to this data. After all the bikers left, what we're seeing is a general decline in mobility towards retail and recreation. And we're also seeing similar trends in Wisconsin and Minnesota. In terms of small business employment, similarly, we're starting to see, we're starting to see a little bit of a decline as well there in terms of small business employment. So none of these are one-to-one relationships, but again, we're starting to see that there is sensitivity related to COVID trends. So a final note, there is a lot of debate about policy and its economic impact right now, and that debate is not unimportant. It's very important. But what I would have you focus on is that consumers as a group have shown some sensitivity and they're changing behavior. Consumer spending is 2/3 of the economy, and they seem to suggest that they're going to be influenced by the degree of control and containment of the virus. Okay, that's an economic truism. It's not a political one. As the virus goes, it's hard for me to imagine an economy that is going to grow and get into positive territory on a permanent basis until there is some control of the virus. These are the things that we're really trying to get a better handle on. There's lots of additional information that we're trying to build into our data gathering to get a much better, more sensitive reading, not only on health trends and economic trends, but how they're interacting with each other. We have a lot of work to do in this area. Our survey work is critical in that as well, in terms of you telling us, what are you seeing in your business? So not only to the surveys that we've been doing in the past, but even the surveys today, this information is really helpful for us. I take this back. It goes into my internal reports to my boss, Neil Kashkari. I want to take the time to say thank you very much for attending today and for participating. It's really useful for me to get in front of business audiences like that, so I appreciate it much. I hope it's been useful. I do have one last ask, and the survey results will not show here, but I'd love to get a little bit of feedback. And with that, while you guys are giving me a little bit of feedback anonymously, I am happy to take any additional questions that have come in, Chad.
Great, thanks, Ron. I'm going to start off with one I have. Early on in the pandemic, there was talk about, will it be a V-shaped recovery or a W-shaped recovery? And now I'm hearing more people say it's a K-shaped recovery. Yeah. Can you talk about that?
Yeah. So in terms of the letters, the V means, we saw a steep decline, and now are we going to see a steep recovery? We think that's not going to be the case. Right now, at least most of the data shows that that's not likely to be the case. W basically means we're going to be kind of up and down. That seems to be a little bit of the case, but I think there's more of an argument to be made about this K. Basically, that some sectors are going to be growing and other sectors are going to be going down. So you essentially have that K, that kind of sideways V, if you will. Some will benefit, some will not, and so we'll see. I think overall we'll see a very uneven recovery. I think right now, until there is control of the virus, I think K is where we seem to be heading right now. I think the data suggests that some sectors have been able to adjust. If you're in a sector that is able to work from home, I'm lucky that I'm able to work from home. There are lots and lots of businesses that are consumer focused, consumer facing. Again, I spoke about hotels earlier. You're not going to be able to work from home at a hotel. So there are very clear winners and losers in this current environment. The one thing I'm unwilling to do, though, is to project very far out. If you think back about, pre-pandemic, that feels like 6 years ago. We've been in the pandemic environment for roughly 6 months. There have been so many changes to the economy. There have been so many things that we yet are still trying to get a real-time measure for, that I'm kind of unwilling to project what this economic recovery is going to look like, a year from now. I get asked that fairly often. And what I would say is, businesses don't have visibility more than a month or two out, it seems like right now. And so I think if we simply see growth over the next couple of months, then I think that's a win. And I think to look too far out is probably not useful, just because there have been so many changes to the economy.
Thanks, Ron. Question from Terry Banaszewski. Hold on one second here. Now I just lost the question. It's about teachers feeling that they want to quit or retire. Distance learning seems to be having a significant effect, but understandably impacting teachers and kids. What are your thoughts on change for education, which does impact workers and future workers?
Change is coming to literally every sector, and education is maybe on the forefront. And I from an economic standpoint, I don't worry about it over the next 6 months. I worry tremendously about the long-term effects of how the shock to the education system is going to affect us long-term. Now, what I hope is that our education system is able to transition to models that maybe teach it new things that will be even more useful in the future economy. But systems are slow to change, and what I worry about is whether or not the pace of change can keep up if we happen to be in this environment longer than we would hope. I would use my own school district as an example in terms of, I think they've done significantly better with the return. I have kids in high school, and they, I think, have done a much better job with the return in September to school than they did in spring. I don't blame them for not doing a great job in spring. They weren't prepared. No one was prepared for what happened in the spring, but they got better. And what I don't know is whether or not the pace of change can continue to evolve as fast as we need it to. They're doing a better job. I would say there are still many, many challenges facing the education system, including what our questioner said is, I think there's a tremendous amount of stress in the education system among teachers, having to do things so differently than they've been used to, working harder, working longer, working differently. So it's something that we're going to have to be tracking it and offering the necessary supports, because we can't not educate our kids as best as possible.
Mm-hmm. Great. Chris, I has a question. Is there economic data on the automotive industry?
I don't have great information on the automotive industry. What I would tell you is that for the information that we do get is we saw really strong auto sales, vehicle sales in general, over the early summer months, roughly May, June, July. We saw really strong. Even August, we saw really strong vehicle sales. I would say the most recent information I've gotten on September is that there appears to be a bit of a pause on auto sales. I don't know whether or not that is because, I think in some cases, maybe some of the stimulus money was helping purchase cars for households early in the pandemic, and that kind of washed through into the summer. It's hard to know exactly where all of that came from. It kind of surprised us, but we have definitely seen a pause in recent auto purchasing activity.
Great. Murray Deeth has a question. He says that General Mills usually benefits from a recession. Is that true this time?
Yeah, it has been actually. And I don't follow individual firms very much. I'm trying to follow a six-state economy. So, but to the extent I am familiar with consumer goods, a lot of consumer goods that you're buying expressly in the grocery store that are packaging for consumption at home, most of those firms are doing better. They're one of the, I hate to use the word winner, they're one of the ones that are doing better in this pandemic than other kinds of goods manufacturers. So yes, General Mills has been doing, I think, better overall than many firms have been during the pandemic.
Great. Jameson Randall has a question. Interest rates are so low. Is there any room to go lower? If not, are there any other options the Federal Reserve can do to stimulate the economy?
Yeah, great question. All these are great questions. I really love the Q&A. I hope I'm offering, the feedback that you find useful. In terms of interest rates, hypothetically, they can go lower. We've seen negative interest rates in other countries. I think, and I can't speak too much in this space because any commentary on monetary policy is above my pay grade. Roughly, basically presidents get to comment on that. What I think I can say is that negative interest rates is not a policy the Fed expects to pursue anytime soon. We have other tools that we've developed during the Great Recession that I think we would probably look to first. A lot of quantitative easing, basically purchases of a lot of government securities and other things to make sure that we can keep markets liquid and that we can keep interest rates as low as absolutely possible. So we do have other tools. I think as we speak, I think we're starting to also now think about, new tools that we haven't developed since the Great Recession. I think we're doing a lot more forward communication. We're trying to really communicate to markets what we expect in terms of inflation and in terms of interest rates, again, with the idea that, investment in the future takes confidence, and the more the Fed can communicate about what it sees and what it expects for in terms of its interest rate policy, I think it's useful for investors to know that we expect a low interest rate environment for the foreseeable future. I think we've communicated as long as 2 or 3 years.
Great. Question from Dan Leggett. With the multitude of much needed stimulus programs, how concerned are you about the tremendous impact on the federal debt, long-term interest rates, the dollar versus world currencies, and the ability or the chance to increase taxes, inflation, et cetera?
I don't think there's any question that there are going to be huge challenges with the federal debt. Going back to my earlier comments, it's the alternative. I think what the Fed has been arguing is the alternative is worse, in that if you're more worried about future debt, you're worrying about you will do that at the consequence of current income, and that would be the economy itself. So if we don't spend some of that money to get the economy back on its feet, essentially get our job and our income back up, then that is probably a bigger problem than the future debt. Future debt is very clearly going to be a problem. It's going to be a challenge for the American economy. Right now, because of how low interest rates are, we actually have every ability to pay for the debt that we've taken on. The problem will be if inflation does show up, and it shows up higher than what we're hoping, that debt is going to get increasingly more expensive. If you think about it as a mortgage, we've essentially taken on a bigger house payment. We can afford that right now, assuming that the economy bounces back. Okay, if you took on a larger house payment and you also didn't get your income got cut, that's going to be a problem. So if we can't revive the economy, that federal debt is going to become a problem sooner.
Thanks, Ron.
But go ahead.
I wanted you to talk about manufacturing a little bit. As I look at your territory, manufacturing is so important, particularly, I'd say, in Wisconsin for their industry. And I look at the Midway area, and we have historically been dependent on manufacturing from the beginning. And I look at the K-shaped recovery and see where manufacturing could be in there. And then I think, we've got that event coming up in a few weeks about supply chains. And I think about the issue of supply chains and also the reliance of foreign companies or companies that have manufacturing overseas. Can you talk about what you would perceive the future of manufacturing in our communities in the upper Midwest?
So going back earlier, I don't want to make too many projections, only because things are really volatile. What I will say is that I think manufacturing in many ways is in a stronger position than some. I think they're starting to figure out how to manufacture, given the challenges of social distancing and things like that. So I think many manufacturers are really competing quite well in the new environment. It will kind of come back to what is demand. I think there may be some of the evolution of the pandemic on where we produce goods could benefit some firms significantly. You may see more of a repatriation or more manufacturing near markets, especially given supply chain. We've seen lots of problems with supply chains. And so there may be things that evolve from that also benefit more domestic manufacturing. What I would say, again, we've only had 6 months of this. I think a year or two from now, it would be very hard for me to predict exactly where this is going because things are still so volatile. I think there are going to be those that benefit. I think there are manufacturers that are going to benefit and those that are not. General Mills being one as a food processor. But there may be others, I think, that are going to see more challenges as a result of the pandemics. But it's to pick manufacturing out of really any of the sectors, I think all of them are going to see challenges. And now that I finally see myself on my screen, I want to apologize for the bright sun that's coming through. Look like I have a skin condition. I apologize for that.
I think more people were focused on the information on the slides, which I think was
I sure hope so.
And look at that, it's 8:59, so we ended right on time. Thank you so much, Ron. This is always really interesting information, and I can tell a lot of people in the audience here really appreciated it and found it very informative. We'll be sending out that PowerPoint to everybody. So Ron, send that over to me. This is recorded, so we'll send the recording out. Please feel free to share it with others. Ron, I'll include your contact information so people
that would be great.
know how to get a hold of you. I saw that on your PowerPoint slide too.
Right.
So
and if I might take 1 second, to all businesses out there, I just want to wish you luck. You're in an environment where it's tough to run a business in normal times. With a pandemic, it's got to be hard times 10. So I just really want to wish all the businesses out there luck. basically just getting through this period with your workers. For those that are still able to keep your workers on, congratulations. You know, I just want to say thanks. You guys are really doing the hard work, and I just want to say good luck and thanks.
Great. Thank you so much, Ron. Again, thanks everybody for joining us, and we hope to see you all soon.
Thank you.